So Joe, I guess with the true-false question now, it's the time of the show that we actually have a question. One of our clients asked you a question. You have not even heard the question, so we got to see how you do kind of on the fly, point blank. So let's roll it.
I've been looking at ETFs and mutual funds and not quite sure where to invest. Can you help me to decide where's the best place to put my money?
All right, great question. So a couple of things. There was an ETF, what means an exchange-traded fund. And then there's also a mutual fund. There's two subtle differences. I'm not going to get very complex here because I only have a few seconds. An exchange-traded fund is basically you're buying the market. So if I want large cap, small cap, mid cap, whatever. An exchange-traded fund, I'm buying the entire index. And it's at a very low cost. I like ETFs quite a bit because they're very transparent, they're very cheap, and they're very tax efficient. There's not a lot of trading that goes on. In an active managed mutual fund, you have a portfolio manager that's buying and selling, or she's buying and selling stocks in a particular category of stocks, such as large companies. So they may be saying, hey, I don't want to buy all 500 large companies, I only buy 200 of them. So they're guessing and speculating on which ones that they feel are going to outperform. So when you look at that, 80% of them fail to beat the overall benchmark, so I'd much rather stick with the benchmark, which would be an exchange-traded fund, which is lower cost, tax efficient, and 100% transparent. Boom.
Killed it.
There you go.
All right, and I would completely agree with everything that you said. And part of the reason why they are cheaper, the internal costs are cheaper, because they don't have a fund manager and a bunch of analysts trying to pick stocks. And interestingly enough, those that do active mutual funds, over the long term, they tend to earn the market return minus their costs. So you're better off with an ETF.